Hey, it's Mike over at Cross Country Mortgage, and it's time for your Monday morning mortgage update for September the 25th. Hope everybody had a great weekend. Gail and I went to the Reading Roots Music Festival this weekend, couple days, saw some amazing music, stuff that you just don't see on the main screen, and just some amazing music. It was a great event. It's the third time they've done it, and it's going to happen. We're putting Reading on the map. So let's talk about what happened last week and what's going to happen this week. I always try to give you tools, tips, tactics, things that you can do to go out and have those intelligent, impactful conversations with your buyers and sellers. And so if we look at last week, it's a big week last week because the Fed met again and made their rate decision. Now they paused a rate hike. We all knew this was probably going to happen. They've been meeting since, they meet every month and a half, but since March of 2022, they've raised the rate every single meeting except two meetings, and this was the second one. So basically the feeling or the consensus out there is that the rate or the Fed is probably going to pause rates or maybe even stop raising rates moving forward, and then let that high Fed fund rate kind of bake the economy into a recession. And the market reacted in a negative way. And I want to show you the charts. The rates actually got worse last week and then got better and then got worse. So this is a snapshot of the trading of mortgage-backed securities on the bond market. When we see this graph go down, we know mortgage rates are determined by the trading of mortgage-backed securities on the bond market, not by when the Federal Reserve raises that Fed fund rate. That impacts credit card rates, auto loan rates, home equity line rates, impacts the interest that businesses are charged to borrow money, but it doesn't have a direct impact on mortgage rates. So mortgage rates are determined by this trading in the bond market. And again, when we see this graph go down, that means rates are getting worse. When we see these little blips of green, that means the rates are getting better. So if we want to look at really what happened over time here, I want to put this in perspective for you because you can see today here, if we look at the 25th of September, rates actually got worse, and Friday they were better, and Thursday they were worse, and Wednesday they were worse, and Tuesday. And why all this volatility, and how does this look compared to where we've been? So I'm going to take you to a really long time frame out, going back more than a couple years, and I want you to see really what the market has done in mortgage-backed security space, so you can get a snapshot of where we are now and where we've been. So we all know that in the 2001 era, 2020, the pandemic was in full swing, and the Federal Reserve bought billions and billions of dollars of mortgage-backed securities. They dumped money in this mortgage-backed security market, and this high level here is the 2 or 3% rates that we all loved. We all appreciated so much. And then in the October and the fall of 2021, inflation really reared its ugly head, and the Federal Reserve finally came to grips that, hey, we've got to start fighting inflation. And the Federal Reserve fights inflation by raising that Fed fund rate because it makes it more expensive for businesses to borrow money. They pass on that expense to the consumer. We as consumers buy less stuff. We head into a recession, and that lowers the prices, lowers inflation. That's kind of a draconian way of how it works. And we can see that from October, November of 2021 until the highest rates we have seen in years was October of 2022, we saw this massive increase in interest rates. Interest rates really doubled in about a year. And then we have kind of rode this volatility wave for the rest of this year or the rest of the last year. So let's go a year out. We can see that in October of 22, the rates were the highest. We saw some improvements, and then we've just seen a general decline in interest rates or higher rates. And we saw high rates in August, and then we're reaching that high level again in September. Why is this? Why have we seen this increase recently? A lot of it has to do with the fact that inflation isn't under control, and we're seeing increased oil prices. And boy, we're all feeling it at the pump. And I've talked about this last week. When oil goes up, everything else is impacted because so much of our products have oil in it, petroleum in it. And so we're going to, until we get this inflation under control, we're going to see these rates come up. So let's talk a little bit more about what the Fed said. So the Fed, in their meeting last week, they meet on Tuesday, they come out on Wednesday, and then they have their policy disclosure on what they decided and why they paused rates. And really what they said is we probably are going to see a pattern of high rates. We're not going to see these rates come down anytime in the future. And that's the Fed fund rate. Why is this? Because they're fighting inflation. Now, a lot of people reacted to this, said, oh my gosh, the Fed's not going to lower rates, but they've been saying they're going to do this. Once they get to that level that they think they're not going to raise that rate anymore, they're just going to let it bake. They're not going to lower that rate until they see inflation get under control. And the fear and the concern that a lot of economists has had is that the Fed's driving us into a recession. And the longer they keep that rate up, the deeper the recession is going to be. And then you add fuel prices on that makes everything more expensive. So this is just the environment we're in right now. Now, if you look at what happened with Monday and Friday of last week, there's only a 20 basis point reduction in the mortgage-backed securities. So the rates didn't get worse or that much worse than they were on Monday, only 20 basis points. But still, the general consensus is we're not going to see these rates come down on the Fed fund rate. The only good news about us heading into a recession is generally, historically, whenever we get into a recession, the housing market does fairly well and rates come down. And so if we see these rates come down, which is going to happen, we don't know when, that's going to increase demand in the housing market. We know we're on a short supply right now. So those buyers that are concerned about the market getting better or hopeful that the market's going to get better and prices are going to come down, a lot of people don't expect that to happen because even though rates come down, that'll increase demand, low supply, and that will drive the market back into possibly higher prices. So what are we looking at this week? I always give you a couple things that are going to affect the interest rates. We're looking at inflation and the Fed. So the PCE, it's the primary measure of inflation that the Fed pays attention to. We have the CPI and the PPI. Those came out a couple weeks ago, but the PCE is really the one the Fed pays attention to. And their core goal rate is 2% inflation. The PCE is a little over 4%. Some estimates expect that to actually come down on Friday. So a lot of attention really is going to be paid to the end of this week and to see what that PCE number is. If it's higher, that means higher inflation rates are going to go up. If it comes down, we might see a little bit of a relief in interest rates. Second thing is the Fed. Now that they had the Fed meeting, all the Fed members, Jerome Powell, everybody's going to be talking this week about what they think the economy is going to be doing. Is it going to be a different message than the Federal Reserve meeting said last week? So we'll be paying a lot of attention to those Fed members and what they're talking about. And then finally, I just want to give you a program that we've just launched. It's a no PMI 30-year fixed mortgage program. You can put less than 20% down, and we're waiving the PMI, the private mortgage insurance on these conventional loans. It's a phenomenal program. Let me know if you have any questions on it. It really can move the needle on making housing more affordable for those that just are struggling to afford buying a house right now. So let me know if you have any questions on that. What are we doing this week? We're really in a locking position. It's going to be a very volatile week, but we're starting out Monday locking, obviously switching to a floating position if anything changes. So if you have any questions, let me know. If you know somebody can benefit from this video, please forward it to them. Have a phenomenal rest of your week. Be productive, and we'll talk to you soon. Bye-bye.